The centre has slashed excise duty on petrol and diesel by Rs 10. Agencies have reported that the government has cut the special additional excise duties on petrol and diesel to Rs 3 per litre and 0 respectively. The Gazette notification was issued late on Thursday. The move to sacrifice revenue by the government will help the oil marketing companies who had to buy crude at much elevated price since the outbreak of the war between Iran and the US on February 8th. However, reports suggest that the retail prices for the consumers, the customers, will not change, meaning the people will be buying the fuel at the prices which they were buying as of March 27th. The other alternative was for the consumer to pay for it through higher retail prices for the petrol and diesel. Reports indicate that Indian crude basket is now about at $147.24 per barrel as of March 24th. India needs to buy about 90% of its crude oil requirements, and the elevated prices can cost the economy dear in the long run. With crude prices jumping from the region of $70 a barrel to more than $115 in less than a month, the oil marketing companies in the country were increasingly facing the hardship as they could not raise the retail prices of the petrol and diesel to pass on the impact to the consumers. The government is trying desperately to avoid the rise in the retail price of the petrol and diesel, which can stoke the inflation in the economy. The oil marketing companies have already hiked the prices of the domestic LPG cylinder by Rs 60 and that of the commercial cylinder by more than Rs 114. In India, petrol and diesel bear the highest taxes in the world. The taxes that are realized upon the product are the base price of the crude oil, plus the excise duty, plus dealers' commission and charges, plus the value-added tax. The crude oil prices, dealers' charges and excise duty remain same all over India. States are, however, free to levy their own VAT and sales tax. Therefore, the prices of these two essential petrol fuels vary from state to state. Since India is critically dependent on the import of the crude oil prices, a rise in its price can have a significant impact on the inflation in the country. According to analysts, 10% rise in crude prices can raise retail inflation by about 30 to 50 basis points. Higher fuel costs raise all-around product by increasing the transport cost of raw materials and finished goods. Rising inflation tend to dampen consumption and weaken the GDP growth rates. Rise in crude prices raise the current account deficit. Since crude has to be paid for in US dollars, which pulls down the value of the Indian rupee against the greenback, it also triggers an outflow of FII investments and dampens the stock market. More than Rs 1 lakh has reportedly flowed out of FII investments in Indian equities this year.